All right, welcome to the final workday of September 2023. You made it through not just another month, but another quarter. Only one quarter left in the year. Kind of crazy. All right, we got a lot to get into as usual. A few things happened this month. Fed had a meeting. They decided not to hike rates, but a lot of things happened kind of post meeting. Once traders, analysts really kind of dived into all the figures, they started to kind of glean a couple pieces of information that spooked the markets in more way than one. So we're going to get into that a little bit. Housing was making headlines and not for the right reason. I want to kind of discuss that a little bit because the news doesn't do a great job of telling the entire story. They do a good job of telling the easier to digest pieces of the story and then ignoring a huge portion of it. So I wanted to really take a quick, hard look at a very specific scenario and actually really get into all the numbers so we can tell the entire story instead of just part of it. Impending government shutdown on the horizon. With any luck, it'll be steered around, but we only have a couple days until that would go into effect. October 1st would be the first day of the government shutdown. Mortgage rates as a whole went from around 7% to 7.375. And then this month we had Labor Day and then the first day of fall. It is officially fall. It doesn't really feel like it, but it's going to feel like it next week, it looks like. So there we are. Let's talk about mortgage rates. They went from, again, 7% to around 7.375 to close out the month. And the big reason why was the Fed meeting. Okay. So, like I said, the Fed decided not to hike rates. Woohoo, that's great news. However, there's two things of significance that happen once the Fed makes their actual rate decision. Number one, they have a press conference after. They release a statement. Not so much a press conference as it is really just a statement. They do have a Q&A session, but it's somewhat abbreviated. So they have a section after the actual decision. Hey, we're deciding not to hike rates, where they will reveal more of what they're expecting to happen going forward. And the second part of that is they will reveal on a quarterly basis an updated dot plot. And this is the dot plot right over here. So each one of these blue dots is a Fed member. This is where they think rates are going to be at the end of 2023. This is where they think rates are going to be at the end of 2024, 2025, 26, and then looking up even further out. So when the traders looked at all of this, the dot plot, they realized a couple things. One, the majority are now calling for one additional hike. This is right where the Fed funds rate is right now, in a range between 5.25% and 5.5%. The majority are now predicting, as you can see, there's more dots, are now predicting one additional rate hike. So that's one big takeaway that they said is, hey, look, there's only 2 meetings left. And according to this, the majority of Fed members think that there's going to be one additional hike. So be aware of that. Two, the majority are predicting rate cuts next year. If you look, you'll see that, hey, look, they're starting to predict rates coming down. You'll also see that there's not a big consensus. There are 4 dots, 4 dots, 4 dots, 3 dots, 2 dots. There's not a big consensus on where rates are going to go from here. They are predicting that there's going to be rate cuts next year, but I mean, not a whole lot. And that was the kind of bigger takeaway, which was, look, the Fed's planning on cutting rates next year, they think, but it looks like there's not going to be as many rate cuts next year, which means the Fed is going to keep rates elevated for a longer period of time. That was extremely significant for a couple reasons. One is there's perceived optimism from the Fed. Hey, if they can leave the Fed funds rate elevated for a longer period of time, it means they feel pretty darn good about where things are at. It means they feel confident in the pace of inflation decreasing. It means they're not really confident that they're at their inflation target yet, which they're not. They've admitted as much. It also means that they're not overly concerned about the jobs market or the economy as a whole. If they were, they'd predict more rate cuts. Well, that perceived optimism from the Fed means, hey, look, we're going to leave rates elevated for a longer period of time. And that spooked the markets. The markets did not like hearing that. They wanted to hear, hey, look, inflation is good. We're happy with where it's at. Start cutting rates immediately and make it pretty dramatic. Now, one big thing worth pointing out, the Fed's track record of predicting where rates are going to go, even a year out, is abysmal. It's absolutely terrible. They do a terrible job of predicting where rates are going to go. They don't know when there's going to be a recession. They don't know when there's going to be a pandemic. And Great Recession, pandemic, they slash rates down to zero. None of the projections accounted for that. So keep that in the back of your mind. Take this with a gigantic grain of salt. However, that perceived optimism from the Fed was not good for mortgage rates. It actually caused rates to increase fairly quickly throughout the week. Rates are now sitting at a 21-year high. So not great news on the rate front. On the housing front, again, I mentioned that there are some housing headlines, and if you look, you would get the impression very quickly that renting is better than buying. Hands down, objectively so, you should rent, you should not buy. I'm here to tell you that they're telling you part of the story. And I don't want to be too negative with regards to the media. I have a very technical sales position. It's a very technical oriented sales position, right? Real estate agent is the exact same thing. You can't just be a salesperson. You have to know the technical side of it. I have to know the guidelines for Fannie Mae and Freddie Mac and FHA and VA. I have to know the portfolio guidelines, the jumbo guidelines. I have to know the different loan limits. There's a lot that goes into this job, I like to think, right? Well, the news media doesn't do a great job of telling all of those intricacies, all of those ins and outs of it. They really focus on one headline number and they really kind of beat that into everybody's head. So from Market Watch, the price gap between renting and buying has hit the widest point since since 2000. Or Realtor.com, renting a starter home is a more affordable option than buying in all but 3 of the largest U.S. metros. That's straight from Realtor.com. Like, they should be on board with buying homes, right? That should be their whole shtick. So you see these headlines and you're like, oh my gosh, it doesn't make sense to buy. Well, here's where they're getting that information from. They are looking at one specific data point, and I'm going to show you that in 2 slides here. Before I do, I need to set the stage of my analysis, okay? So this is a 3-bed, 2-bath townhome in Erie, $460,000. I chose this for a couple reasons. One, it's between Boulder and Denver. So it's kind of trying to cover the entire kind of greater metro area that we are in. 2, townhomes actually tend to be more expensive than single family homes because they have those HOA dues, right? So that's going to make the payment on a townhome look higher than it would for an equal price single family residence, unless it's like a patio home, that kind of thing. But for the most part, a $460,000 townhome is going to have a higher payment than a $460,000 single family residence. So I'm intentionally starting from a place of somewhat conservative figures. That's how I wanted to go about this. I don't want to paint you a very rosy picture and say, oh yeah, Aaron just tried to find data to fit. It's definitely not the case. I used a rate of 7.5% for my analysis. Rates today are 7.375. So I used actually a slightly higher rate than what they are at today. I used 4.37% appreciation. I got that from a couple different forecasts for this one specific area. For what it's worth, over the last 8 years, this house has increased in value 12.7% per year over the last 8 years. So those were some COVID-19 years. We saw a lot of rampant appreciation in there. I tried to account for taking those out by using a significantly more conservative figure than what we've seen the last 8 years. I'm all trying to make this set up very, very fairly. I used a 6% annual rent increase. The national average is 8%. I used 6%. Again, trying to be very fair and conservative with regards to these numbers. I also want to mention that none of the reports account for one of those variables, which is annual rent increase. They just assume your rent's going to be the exact same going forward forever. They don't account for annual rent increases at all. If you've ever been a renter, you know for a fact that it's not the case. Unless you have a landlord that just doesn't care, your rent's going to increase over time. None of the analysis, none of the stories that we were talked about already here account for any rent increases at all. I used 10% down. I didn't use the least amount down because that would skew the numbers in a more favorable way in one direction. I didn't use a larger down payment because that would skew them in another way. That would make the payment look significantly lower. So I tried to use a pretty decent number for that as well. I used 7% for selling costs. So I accounted for 7% in real estate selling costs. Again, that's probably high. I've been trying to be very, very fair to set up the table before we really dig in. All right. So this is where those headlines arrive, okay? They look at purely, hey, what's your monthly payment if you're renting? What's your monthly payment if you're buying? I looked at this exact same property and figured out what it was renting for, okay? It was renting for $2,300. You also have to account for your renter's insurance. I used a pretty low number on that, $35 per month. Again, trying to be very fair. That mortgage payment, using all those assumptions, is going to be about $3,408. So that's where these articles start and stop. They only look at this one piece. Over the course of 5 years, a renter would save $47,254 versus buying that property. That's where they start. That's where they end. They only look at that figure. Well, if you own a house, or if you're in the market to look at a house, there's 2 additional variables. I already talked about one of them, which is increases in rent, but there's 2 additional variables that are being missed, which is Oh yeah, that cash flow, that monthly cash flow, that monthly payment that you're making on the mortgage, part of that includes actually paying down the principal balance on your loan. You are deferring that money into a very long-term certificate of deposit. You'll eventually get it back when you sell your house, right? You're paying down your loan, you're paying down the principal balance. That is additional money you will walk away with at the end of the day when you eventually go to sell your house. They're excluding that from all of these reports. That's kind of a big thing to skip. The other thing is there's appreciation. When you rent, money out the window, money into the wind, money down the drain. You're never going to see it again. When you buy a house, you're going to have appreciation. I used a very conservative number with regards to that. But after 5 years, you'd have $109,560 in appreciation. So, yeah, if you simply look at ingo and outgo, renting is going to come out ahead. We have amongst the all-time highest values of real estate. We have 21-year high in interest rates. Yeah, it's expensive to buy right now. There's no getting around that. I will also say I'm a big proponent of like whatever is ultimately best for consumers is best for me and everybody else involved. I don't want to force people into homes if they can't afford to buy a house. That goes against everything I believe in. Okay. But I also think that if you only look at ingo and outgo from your bank account, you're missing a huge part of this equation. And here's the big reason why. So for the first 2 years, if you were renting, yes, you would come out ahead. You don't have that large down payment of 10%. You don't have your closing costs. You don't have your prepaid expenses. And oh, by the way, your monthly payment's also going to be less if you're renting. All true, right? For the first couple of years, if you're renting, you're going to come out ahead. Starting in year 3, you're going to start to come out ahead. And I do take into account the cost to sell the house. I do take into account the upfront down payment. I take into account all of that with this analysis. Starting in year 3, you're going to start to come out ahead. Once you get to year 5, you're now ahead, additional wealth gained, almost $47,000, $46,923. After 7 years, it's $102,527. After 10 years, it's $216,293. So is renting better in the short term? Absolutely. Is it better for your long-term wealth gain? Absolutely not. And I can objectively so that right. That's simply not the case long-term. Even starting in year 3, you're going to start to come out ahead. I had a conversation with a first-time home buyer yesterday. I'm like, I think buying still makes sense. However, if you're going to be moving in the next couple of years, I wouldn't advise it. I think that's true. Selling house is expensive. It's cheaper to buy, expensive to sell real estate. And also worth pointing out, this does not account for eventually refinancing the loan to a lower rate, which is going to happen in the next few years. It does also does not account for removing mortgage insurance early. It assumes you're going to have it forever. So I was trying to be very fair. I was trying to be very safe with these numbers. I hope I did a good job here. But starting in year 3, you're going to come out ahead. If you just read the headlines, you would get the impression that you're better off renting. Maybe right today, maybe right now, maybe for the next several months. But long term, definitely not the case. So government shutdown is currently looming. It's hard to talk about this topic only because by the time you watch it, it could be taken care of. We could all be fine. So I'm going to kind of go a little bit quicker here, okay? As of, let's see, almost 10 o'clock on Friday, September 29th, there is a government shutdown looming. It would take place on October 1st. That is when there would officially be a shutdown. There's been 14 funding gaps since 1981. The longest one was the most recent one as well. That was 35 days. And that was from December 2018 through January 2019. If you recall, that was right in the peak of the travel season, and TSA workers were, a lot of them weren't showing up because they weren't getting paid. So they were asked to be working without pay, and a lot of them weren't comfortable with that. A lot of people were calling in sick or, kind of silently protesting. Some of them were slowing down in kind of a way of showing somewhat of a protest. And there was lines at airports that literally wrapped around airports. It was brutal. If there is a shutdown, expect something similar. IRS slow down as well. There's just not going to be not nearly as many people on staff there. So filing returns, getting refunds may potentially get delayed. If you're needing to get a hold of the IRS, that would be delayed as well. There's 1.3 million active duty troops. They would have to work unpaid. So there'd be a lot of households getting squeezed. 2.2 million federal employees that may start to miss checks, get furloughed. Also, a lot of them are probably going to go on unemployment. So that's going to skew some of those numbers when the time comes. National parks, museums, and zoos, that's not every national park, every museum, or every zoo, but a number of them may be impacted if this happens. SBA loans, Small Business Association loans, and then SNAP, which is like food stamps, formerly known as food stamps programs. Those could all be impacted. A lot of food banks won't be able to place orders for new food. So there's a lot of concerns all in all of this. As of right now, the Senate came to an agreement, a bipartisan agreement, said, hey, look, we got a solution. The concern is that the House is going to squash that. There's a lot of division right now in the House, not just between parties, but honestly within parties as well, as McCarthy is certainly figuring out right now. So that's kind of where we currently stand. They may come up with a solution in the next 48 hours. We may be able to avert this. This may not come to fruition, but if it does, expect disruption with regards to all of this. Okay. So looking ahead to October, honestly, a lot of it depends on the government shutdown. Hopefully, I'm still cautiously optimistic that they're going to come to some kind of agreement here. It's all hands on deck over there right now. But if there's a government shutdown, Bureau of Labor Statistics, jobs reports, unemployment numbers, all of those are going to be impacted. We're no longer going to have inflation figures being reported because all of those come from the government. So it would impact the reporting of all that information. The problem with that is traders use all that information as, data points, landmarks to navigate the seas of the market. And if all that stuff is missing, they're kind of operating somewhat blind. So there might be more volatility in the market potentially as well. Currently, we're scheduled to get jobs data next week, October 3rd, October 6th. We're also due to get inflation data October 11th and October 12th. So we'll see if that comes to fruition or not. It really depends on how things go in the next few days here. That is all I have for September. Thank you all so much. If you have any additional questions, let me know. And then thank you for all the referrals, lifeblood of our business. We can't survive without them. So thank you so much. I appreciate you all. And if you have any other questions, let me know. Thank you so much, and have a great weekend, and hope you had a great fall ahead. Thanks. Bye.